Welcome to the deep dive. Today we're digging into something that really shapes the financial world, maybe quietly. Credit ratings.
hmm
Think of them as like an independent check on whether a big company or even a government is likely to pay back its loans, its debts.
Exactly. It's a crucial piece of info for financial stability.
Hmm.
At its core, really, a credit rating is trying to estimate the risk of default.
Default meaning they just can't pay.
Right. The chance that an entity, a company, or government won't be able to meet its debt obligations. So, for anyone thinking about buying bonds, this is pretty fundamental.
Okay, but let's be super clear here. We're not talking about your personal credit score, the one you might check yourself. That's totally different.
Totally different thing. Credit ratings apply to these bigger entities, companies, countries,
Yeah,
uh, government agencies.
gotcha.
So, yeah, while both things, scores and ratings, measure credit worthiness, one's for individuals, the other's looking at the financial health, the borrowing capacity of, well, large organizations.
So, our mission today in this deep dive is to really unpack what these credit ratings are, why they matter so much, and, what those different letter grades actually mean.
hmm And we'll get into the key players, the big agencies, and a bit of the history, too.
Yeah. The goal is that by the end, you, the listener, have a really solid handle on this important financial idea.
Okay, let's unpack it then. What are we looking at more closely with credit ratings?
Well, basically, they're an expert opinion, an estimate of the risk involved if you lend money to these different entities, businesses, governments, what have you.
Yeah.
A high rating, that suggests, they're very likely to pay back on time. A lower rating, though, signals potential money troubles, a higher risk they won't meet their obligations.
And these ratings don't just appear out of thin air, right? I understand bonds get rated before they're even sold.
That's right, before issuance.
And here's the really interesting part for me. That rating directly links to the interest rate. Oh, absolutely. Huge link. If an entity gets a lower credit rating, it's seen as riskier. So to get people to invest to buy their bonds, they generally have to offer a higher interest rate.
To compensate for the risk.
Exactly, to compensate. But if you've got a strong rating, a top rating, you can often borrow more cheaply, offer lower interest rates because your debt's seen as safer.
So investors, lenders, they're using these ratings to decide where to put their money and figure out what return they should expect.
Okay, we mentioned letter grades. What's the system there?
Yeah, the big agencies, they use these standardized letter grades. It's a kind of shorthand.
Yeah.
So S&P Global, for example, goes from AAA, that's the best, all the way down to C, and then D for default.
Okay.
Moody's has a very similar system, FE down to C. It just gives investors a consistent way to compare the risk level between different borrowers.
And it's not just about debt that lasts for years and years, is it? I think I read somewhere ratings cover shorter periods too. That's correct. Yeah, you can have short-term ratings. They focus on the risk of not meeting financial commitments within about a year. And actually, these have become more common lately.
Hmm.
Long-term ratings, like the name suggests, look further out their ability to repay debt over a longer stretch of time.
Okay, so this whole system, it's been around a while. It has a history.
It does, yeah. The roots go back to the early 1900s, really. But a key moment, a really pivotal one, was in 1936.
What happened then?
U.S. federal banking regulators, they brought in a rule stopping banks from investing in what they call speculative bonds, basically bonds with low credit ratings.
Ah, okay. That makes sense. Trying to protect the banks from risky investments.
Precisely. The idea was to cut down the risk of defaults that could cause banks to fail. And, that rule really pushed the widespread use of credit ratings as a core tool for checking financial risk. It's kind of solidified their importance.
So, who are the main players doing these ratings today? We've dropped a couple of names already.
Yeah, the market is really dominated by three big agencies: Moody's, S&P Global, and Fitch Ratings. Between them, they have, well, most of the market share.
The big three.
Pretty much. And importantly, they're designated as nationally recognized statistical rating organizations, NRSROs for short.
NRSROs. Okay, what does that mean
It
exactly?
means they're subject to oversight by the U.S. Securities and Exchange Commission, the SEC. So there's a regulatory layer.
Right, it's not just random opinions. There's some official status and oversight. Okay, let's look at each one quickly. Maybe start with Fitch.
Sure. Fitch Ratings, founded back in 1913 by John Knowles Fitch. At first, they were more about publishing financial statistics, things like the Fitch Stock and Bond Manual.
Just data initially.
Yeah, mostly data. It wasn't until 1924 that they introduced that AAA to D rating scale we know today, and now they're global. Offices, analysts all over the world.
Okay, and Moody's, how did they get started?
Moody's Investor Service. That goes back to John Moody in 1900. He published Moody's Manual of Industrial and Miscellaneous Securities. But interestingly, like Fitch initially, his first manual had tons of data, but no actual ratings.
Huh. When did the ratings start?
That came in 1909. He started rating railway securities in a publication called Moody's Analyses of Railroad Investments. Then later, they expanded into utilities, other industries, and just like Fitch, they grew to this huge global company.
And the last of the big three, S&P Global, sounds like their origin involves a merger.
That's right. S&P Global's story starts way back in 1860 with Henry Varnum Poor. He was focused on railroad data. Then separately in 1906, you had Luther Lee Blake, who started the Standard Statistics Bureau for, other types of companies.
Okay, two different streams.
Yeah. Poor's started rating in 1916, Standard Statistics in 1922. Then in 1941, they merged to become Standard & Poor's Corporation.
Oh, there's the name.
Right. Later on, they were bought by McGraw-Hill, and then in 2016, rebranded to S&P Global. And again, massive global presence today.
Wow, okay. So these three really have deep roots and have defined how we look at credit risk. We've talked investors, but why are ratings so vital for the companies or governments getting rated?
Oh, it's absolutely crucial for them. A good credit rating is like a key to getting capital, to borrowing money. A higher rating usually means they can borrow at lower, better interest rates.
Makes sense.
But a poor rating, that can make borrowing way more expensive, or sometimes even cut off their access to the funds they need. And it's worth remembering, usually the company or government asks for the rating and pays the agency for it.
Interesting. So they pay for a judgment that then affects their borrowing costs, right? Let's get specific. The letter grades. Can you walk us through that scale again, maybe comparing the agencies?
Sure. For long-term debt, the scales are very similar. Top of the line is AAA from S&P and Fitch. Moody's uses AA, highest possible credit quality.
Okay.
Then you go down, AA or AA from Moody's,
Right.
A, and then BBB back. These are all generally considered strong. Below that, you get into what's called speculative territory.
Speculative, meaning riskier.
Yeah, higher risk. That's where you find BB, BB, CCC, KAC, CACC. And then at the very bottom, you have D, or sometimes RD, indicating the entity is already in default or very close to it.
And I remember you saying there are finer distinctions within those letters, like pluses and minuses.
Yes, exactly. S&P and Fitch use a plus or minus online for ratings from AA down to CCC. So like AA plus is slightly better than AA, which is better than AA.
Okay.
Moody's does something similar but uses numbers, 1, 2, and 3. So within the BA category, for example, BA 1 is the strongest, BA 2 is in the middle, and BA 3 is the lowest, but still investment grade.
Right. That term investment grade, that's a really key dividing line, isn't it? Where does that fall?
It is super important. The cutoff is BBB for S&P and Fitch, and BA 3 for Moody's. Anything at that level or higher is investment grade. It suggests a relatively low risk of default.
And below that?
Below that, so starting at BB plus for S&P Fitch or B1 for Moody's, that's speculative grade or non-investment grade, sometimes called high-yield bonds.
Or junk bonds, less formally.
Or junk bonds, yeah. That term gets used a lot. Right. It indicates a higher risk profile.
So when these agencies are deciding on a rating, what are they actually looking at? What factors go into it?
Well, each agency has its own sort of secret sauce, its own specific formulas, but they generally look at a common set of things.
Like what?
Okay, so definitely payment history. Have they ever missed payments or defaulted in the past? That's huge. They also look hard at how much debt the entity currently has and what types of debt.
Makes sense. What else?
Current cash flow is vital. How much money is coming in? What's their income situation? They also consider the bigger picture, the overall market, the economic outlook, and any unique things about that specific company or government that might affect its ability to pay back debt.
So it's not just crunching numbers from the past, it's also looking forward, trying to predict the future a bit. Seems like there's some judgment involved.
Absolutely. There's definitely a qualitative element, a judgment call about future prospects. It's not purely mechanical, and that's why ratings aren't set in stone. They can change. An agency might downgrade or upgrade an entity if their view of its creditworthiness shifts.
Right. Even if they have a good history, if the future looks rocky, the rating could drop.
Exactly.
Okay, let's quickly circle back to the credit rating versus credit score difference, just to make sure that's crystal clear for everyone.
Sure. Simple distinction, really. Ratings are for organizations, companies, governments. Scores are for individuals, for people.
But they do a similar job.
Fundamentally, yes. Both are trying to signal the risk level for a lender. How likely is this person or this company to pay back the money they borrow?
Okay. So if I'm an investor, how should I think about a credit rating? What does it tell me?
Think of it as an educated opinion, an expert assessment of how financially healthy that company or government is, and crucially, how likely it is to repay its debts.
So I'd use it to decide, do I buy this bond?
Yes, and also, is the interest rate they're offering enough to compensate me for the risk level that rating suggests? It's also really useful for comparing different bonds, different investment options side by side.
Got it. And these NRSROs, the nationally recognized statistical rating organizations, they don't just operate in a vacuum, right? There's oversight.
That's correct. NRSROs are regulated. They fall under the oversight of the Office of Credit Ratings, the OCR. That's part of the SEC, the Securities and Exchange Commission.
And that OCR is relatively new.
Relatively, yes. It was set up after the 2008 financial crisis as part of the Dodd-Frank Act. The whole point was to bring in more regulation, more accountability, more transparency for these really important rating agencies.
And Fitch, Moody's, S&P, they are all current NRSROs.
They are, yes, among others, but they are the main ones we've discussed.
Okay. So wrapping this up, it seems clear from our deep dive that credit ratings are, well, they're indispensable tools in finance.
Absolutely. For investors, they offer this informed judgment about risk. And for the companies and governments being rated, they're critical for accessing capital affordably.
But, and this isn't important, but they aren't crystal balls, right? They're not guarantees.
No, definitely not. As valuable as they are, they represent an expert opinion based on the information available at that time. They aren't foolproof predictors of what will happen.
Right. An informed perspective, not absolute certainty.
Exactly.
So thinking about the history we talked about and just how much influence these big three agencies have globally, it makes you wonder, doesn't it? How might big shifts in the world economy or, some major unforeseen event, how might that change the future of credit ratings and change their impact on how everyone borrows and invests down the line?
That's a really interesting question to ponder.
Definitely something to think about as you navigate the financial world. Thanks for joining us for this deep dive.